Hello, hello. It is great to see you again, and welcome back to another installment of Modern Wealth Management. I'm your host and moderator, Ryan Ruff, but you knew that already because you're a frequent viewer on this show, and it's great to have you back with us for today's conversation. And I'm excited about today's show for a lot of reasons. Most importantly, we've got a special guest joining us today, Miss Lisa Curry, to discuss some, year-end tax strategies amid the wide variety of tax proposals that are out there these days. So, what we're going to be doing today for today's conversation is we're going to toss it over to Darrick. Darrick and Lisa are going to drive the conversation. I'll be hanging out in the background to field any questions or comments that might come through on today's live stream here. But either way, we're going to let them kind of drive the conversation forward. A lot of great stuff to get to, given all of these tax proposals and what that can do to your financial portfolio. So we've got a lot of good stuff to get into today. So I'm going to go ahead and toss it over to Darrick to get the conversation rolling.
Thanks a lot, Ryan. We're so happy to do this again, and I am thrilled that Lisa is able to join us. One of the things that makes Monon Wealth Management a little bit different than other investment management firms is that we really focus in on advanced planning through what we call a virtual family office, and that is where we really understand who our client is and then try and build a professional team around that individual or family so that we can not only increase their wealth through proper investment management, but also do 4 other things: mitigate taxes, help them get their arms around the things that they already have so it can't be taken away from them unjustly, make sure that they take care of their heirs, and then maximize their charitable donations to whatever extent they are charitable. Today, we're really going to focus in on that first part, which is mitigating taxes. And I'm not real sure if there's ever been a year where I've been in business, and I've been in business now for more than 20 years. I don't know if there's been another year where there's less clarity on what we're going to be doing with taxes moving forward. I mean, as we sit here today, we've heard all kinds of different proposals that have been suggested. We know that Congress and Senate and President Biden, everybody has their own agenda. They're trying to figure this thing out and trying to negotiate where we move forward. So with a lack of clarity that we have right now, I really wanted to bring in one of our most important partners, and that is Lisa Curry. Lisa is a tax expert and a partner at Katz, Sapper Miller, and I want to introduce you to her right now. Lisa, how you doing?
Hi, Darrick. Good to see you. Thanks for having me today.
Oh, I appreciate you carving out some time in your schedule to spend some time with me and our clients and all the viewers. Lisa, just to kind of kick things off, why don't you tell us a little bit about the firm, about you and the firm that you work for?
Sure. So as Darrick said, I'm a partner at Katz, Sapper Miller. Otherwise, sometimes you hear us referred to as KSM. So either of those, that's who we're talking about here. We've been around, we've been doing business for coming up now on 80 years, have primarily been focused, a public accounting firm that has primarily for decades been focused on tax and audit services. Still, our core services that we provide are definitely in that tax and audit field, but then we've grown exponentially over the years, grown with new clients, with our original clients, in helping them expand their business, sell their business, grow their business, give to their children, pass along in their family, really kind of anything you think. We're very entrepreneurial based, so we've got a lot of kind of what you would call mom and pop shops that we've worked with from the beginning, and then we go all the way up to multi-million-dollar clients that we work with from a, like I said, audit or tax standpoint. So kind of cover the array of being, what you hear in that trusted advisor role for our clients.
That's great.
Go ahead.
Yeah, no, I think that's one of the reasons that we've partnered so well. We serve a similar clientele, that entrepreneurial focused individual who is really focused in on not only taking care of their business, but using the business as a means to take care of their family. Wouldn't you find that that's kind of a characteristic of a lot of the people we take care of?
Yep, absolutely.
Yeah.
Yep.
Yeah. Well, listen, Lisa, we've been hearing lots of rumors lately. And it does, I read the Wall Street Journal every single day. I read Barron's on the weekends, and like a lot of our clients, the news is frequently on, and it's really, really tough to understand and decipher everything that we're hearing around the tax environment. Can you kind of lead us down this path and tell us, out of all the rumors that we're hearing, just paint us a picture as to what is going on?
Sure, absolutely. Now, I will tell you, we'll start this conversation and we may end up in like 5 different directions at different times, and we'll come back and revisit. And that kind of seems to be the way some of these tax provisions go. But obviously, it'd be ideal, right, if we had a crystal ball and could say, okay, here's what this year is going to look like, or starting in 2022, here's what the changes are to the tax law, and here's what we're going to see, and here's how we plan for it. I think, as you alluded to earlier, this year has been a tricky one when it comes to trying to provide those planning services, whether it be just around your tax planning for your business, for you individually, or if it's as far as if you're close to that kind of succession planning, and is it time to sell my business? With a lot of the stuff that was talked about in these early provisions earlier in the year, people, I think, were kind of rushing to, hey, if I'm close to selling my business within a couple years, maybe it's time, because I want to avoid these increased tax rates that I'm hearing about, and I want to avoid the increased capital gains rates that I'm hearing about. So I think there were a lot of people exploring those options, kind of looking at those types of things and planning in that way. And now, as we talk more, you'll see, and I won't go through all of the history, but the current proposal that is out right now that's waiting on the Senate to pass has pulled a lot of those changes out that we heard about in the beginning. So I think what's important as we're talking today is not only to kind of talk about what's currently sitting there, which again, I'll say has not passed. And as I'm talking about some of these things, and I want to make sure and remind everybody that it's not definite because it hasn't passed, but we'll talk about what we're seeing right now in the current proposal. But I think it's important that we also touch on what everybody has probably heard over the past year, because there's been some of those changes where it's kind of like you start thinking, you're like, well, I heard my tax rate was going to go up 2%, and now you're telling me it's not. Was I dreaming? Was I crazy? So I just think it might be important for us to kind of touch on those and say, well, yes, this is what you've heard, this is where it's gone, and here's where we're at right now.
Yeah. I would agree. And there isn't a day that goes by that I don't hear about something new. And there isn't a day that goes by that I don't get a question about from a client or a prospective client about, hey, I've heard this, and what does that mean for me?
Right.
If it's difficult for professional advisors like ourselves, Lisa, it's got to be extremely challenging for our clients.
Yeah. And difficult. I mean, look, I have notes with me, because literally, as we're sitting here having this conversation, some of these things we're talking about could be changing, as we're talking. It's just such an ever-changing environment with some of this stuff. So yeah, I'm sure it can be it's overwhelming for people who aren't in this industry and in this field every day to hear some of the stuff they're hearing and know what to do with it.
All right, well, let's give them some ideas. So, we've heard lots of things thrown out there. Why don't you kind of decipher, out of all the stuff that's gone out there, what has kind of already gone to the wayside and is less likely to actually make it into law? And what is it that we really need to be prepared for and be thinking about as we move towards the end of this year and into 2022?
Sure. So the most recent probably that you've heard of, or you might be hearing in the news, and what just a few days ago was passed by the House, is the BBBA, or the Build Back Better Act. There's lots of acronyms you hear on different things, and we'll touch a little bit on obviously the past 2 years, year and a half, 2 years, there's been lots of different acts related to COVID that have had lots of tax implications. So lots of acronyms out there, and it's like, what's this act and what's that act? But where we sit right now with the BBBA, one of the I wrote down kind of the top 3 things that probably affect most of the people listening to us today, is a lot of conversations back in May when the first, the Green Book is what was coming out with new tax provisions. One of the hot topics that was being talked about is that corporate income tax rates were going to increase. So currently, a C Corp, when you're paying tax as a corporation, the current corporate rates are 21%. So originally, back in May, and even then in August and September, they were with the House Ways and Means, they were talking about increasing that to 28%. That was the initial proposal. Second proposal, the House Ways and Means, they had adjusted a little and said, I think they said they would have it more of a graduated, like 21 up to 25%, depending on your income, and it would be a graduated scale. Well, now here we sit with the most recent proposal, the BBBA, and they've completely pulled that out and said corporate tax rates are going to stay at 21%. So from a corporation standpoint, we're kind of back where we started. That's one of those, I don't know if there were if anybody, I know a few years back when rates changed significantly with the TCJA, lots of companies corporations were looking at, hey, should we consider making an S election or doing something like that?
Yeah.
I don't know. I personally did not have a lot of clients or corporations that with this discussion of rates going to 28% where we seriously considered it, but there may be people out there who were considering maybe an S election to avoid that increased rate. But again, where we sit today is that we're back at the 21% for corporations.
No changes on corporate.
Right.
And I'll tell you that, one of the reasons that is so important for our clients is even if they don't own or if they don't participate in a C Corp, well, I got news for you. Every publicly traded stock that's currently in your portfolio is a C Corp, and them and increasing their tax rates on that corporation would seriously have an impact on future looking after tax earnings, which, as we know, ultimately can affect stock prices. So glad to hear that at least for the time being has been taken off the table. But what about this? What about this thing out there? And I don't, before we get into your other bullet points here, I'm hearing about this minimum tax, this global minimum tax on corporations. I think it's at 15%. How does that coordinate with this 21% that I'm seeing now?
So this 15% tax it's a little bit of a unique. It's what's considered a minimum 15% book tax. And so I say that without going into a ton of detail, but basically you've got your audited financial statements or your book income, which a lot of times doesn't necessarily match taxable income because there's various book and tax differences or timing differences from, accrual versus cash and whatever that might be. So this was to looking at true book income and saying, hey, what your book income is, there's going to be a minimum 15% tax on that. Now, having said that, that is for corporations that have income over $1 billion. So that really, I've got a couple notes pulled up in case I want to say, I may say the wrong number, but I want to say that's like maybe top 500. That's very few corporations.
Okay.
Especially the ones that we're working with. That's very few corporations that would affect. That would have to pay that 15%.
Well, it's really aimed at, that rule, that global law that is being agreed upon is really for the largest multinational companies that exist in this world. So, we're really talking about the top of the top, the companies that not only compete here in the United States, but they compete in Europe and China South America and so forth. So
Yep.
so that's good to know. But I'm glad that that's been pulled off. It's another thing I can stop losing sleep over at night.
That's
And
just to give an idea on that, the BBBA, the tax provisions, the tax increases in there have the goal of raising about 1.48 trillion. And that portion of it, this 15% minimum book tax, and you can see I'm cheating because I had pulled up some of
no, that's fine.
That 15% minimum book tax is intended to make up about 318, almost 319 billion of that 1.48 trillion. So that's kind of you can do quick math in your head, you can tell what percentage that is, but that's kind of the makeup of that part. That piece is a goal of 319 billion of the trillion they're trying to make. So
great. Well, the next thing that I wanted to ask you about is this top individual income tax rate, and this really does affect directly our clients.
Yeah.
What's going on? Are they raising our tax rates or not?
Well, as of now, no. As long as this gets through the Senate and this is what passes. Again, this has been big discussion all year, and really in each of the different provisions, this was always in there that the tax rate was the top tax rate, which is currently 37%, was going to increase to 39.6. And then in this last round, they pulled that back out and kept it at 37%. So again, that's like you said, a lot of our listeners today, a lot of our clients that we work with every day, this directly affects them. Mm-hmm. And you think of it it's like, oh, it's what, 2.6% increase. Is that really? That's not that much, but it is if if you're in that top tax bracket, you're over, you're $500,000 of taxable income, close to that. So 2.5% on that starts to add up pretty quick, especially when there's other taxes on different things that come in. So that is one of those where, as we were planning throughout the year, with our individual clients where we plan for their quarterly tax estimates, that was something we were, taking into account and saying, okay, if the tax rate's going to increase, you're going to owe more. So do we want to get some of that paid in now? Do we want to just plan for it and know you're going to have a big bill in April? So, that's where some people could see some difference if they planned for that increased tax rate and went ahead and kind of paid in with their quarterly estimates based on that. Then they may have some good news in April because they may be a little bit overpaid.
Maybe get a little money back.
Yeah.
All right. Well,
let's often, right? We see these big, with new administration and big tax changes coming in. Sometimes there's usually pieces of good news, but it feels like there's still always some hits here and there. Individuals are always going to see some hit on their tax. So having this come back out, it was, kind of good news for our top bracket taxpayers.
All right. Well, that's good news. What about this capital gains rate that we're hearing? I hear there's big changes on that, and clients have been asking me, is it imperative that if they're going to sell their business over the next 5 years that they get it done by 12/31 of this year? We're also looking at, hey, the capital markets have been good. We have, here at Monon Wealth, we have some clients that have huge capital gains on some of their holdings.
Yeah.
What's going on with this, and how do I need to prepare?
So this is another big one where throughout the year, if you were kind of planning for what they were talking about, which was, so right now capital gains rates, I'll talk in, capital gains rates are basically 20%. If you're in a lower tax bracket, let's see, if your tax bracket's from 80,000 to, this is married filing jointly, up to 500,000, then your capital gains is actually only 15%.
Okay.
Anyone over 500,000 is 20%. So that's the current capital gains rates. The discussions in May, and then again, even with the House and Ways, which I think was around in September, was that that was going to go away. Again, I think this was for the higher income taxpayers, but the capital gains rate was going to go away, and their capital gains were going to be taxed at ordinary tax rates. So we're talking a spread from you used to paying 20% on capital gains to what they were talking about if they had increased the rate 39.6%. So almost 20% increase of tax on your capital gains. So, right, like you mentioned, from a planning standpoint, we have a transactions group within KSM who helps with buy side or sell side due diligence with any types of transactions, and they are busy, like crazy busy, because again, a lot of these business owners who, maybe they were 2 to 3 or even 5 years out from considering selling, retiring, selling, or there's a lot of action out there with PE firms buying. So any of those considerations, and these people are thinking of selling a business with probably pretty sizable gains, that's a 20% tax difference that they were potentially going to realize. So
Yeah.
I think a lot of people did start exploring that. Where we stand today is that has been, again, out of the BBBA, that has been pulled back out, and capital gains rates are going to stay as they currently are, which is the 20% rate for most people, or the 15% rate.
Okay.
So again, another one from our individual standpoint, or business owners that might be going through transactions, another piece of really good news that we like to hear.
Yeah, so maybe there's not the increased rush to get this done in 2021. Is that what I'm hearing?
Right, exactly. You've got a little more time. And I don't know on your end, maybe you can speak to this a little bit as far as, we would get questions sometimes from, should they be harvesting losses and trying to offset some of their current gains? Obviously, that's always one of those topics where it's like, from a tax standpoint, here's what it could do, here's what we could save. But again, ultimately, you've got to be involved in what's best for their portfolio and their investment strategy and what that looks like. So I'm sure that's conversations you've been having with your clients in navigating these potential capital gains changes.
There are, there are a lot of consequences to taking capital gains. And one is that you have to pay the taxes. The second part is that you have to find new places to invest that same capital. And so I'll just give you an example. I mean, we're here in central Indiana. Eli Lilly is probably the largest holding here in Indianapolis amongst all of our citizens and certainly our clients. And it's had a heck of a run. Well, we've been having these conversations about, hey, you've got these huge gains. Should we take them this year versus sometime down the road? Because one of the other things, Lisa, that we've been hearing about is that that maybe we're going to lose this step up in basis when we pass away. And just to kind of remind our audience, what this means is that, if you had $1 million gain in Eli Lilly stock, well, if you pass away, your children or whoever it is that inherits that money, well, they inherit it at a stepped up cost basis. They inherit it with a cost basis at the same price it is on the day you die. And boy, when they said that they might be pulling that threw a lot of planning questions our way. Can you comment on that? Because It seems like that one's maybe died a little bit, but why don't you tell us what's going on? How do we get there, and where are we going moving forward?
Yep, you're exactly right. That was a huge hot topic. And I think that was one too. I think people would hear in the news and maybe didn't totally understand what it meant, but they knew it meant something, that what they've worked for to save and be able to give to their children or grandchildren was suddenly going to cost them, cost their kids more tax. And so I think trying to understand that and know what it meant, I heard a lot around that. But yes, where we stand today is they have pulled that back out. So that was the discussion that was in the original provisions, was that they were going to take away that step up in basis. So essentially, in like the example you gave, if someone's got stock that they've held for a really long time, they may have very low basis in it, and then they pass away and their kids inherit it. There could be, let's say there's $100,000 gain there based on their basis and what it's worth on the day they die. Right now, that $100,000 gain basically goes away because the who inherited it gets the basis, like you said, on that day.
It goes away for tax purposes. There's no tax that's going to be paid on that 100,000.
Exactly. And they were talking about pulling that out and saying, nope, when they inherit that, they've got to pay tax on that gain. They don't get that step up in basis. And that, that could have been really big for people. And
yeah. Well, it's one thing if you own some liquid Eli Lilly stock and you can sell some of it to cover the taxes. But I want you to think about if it is a family that owns a trucking company that's $70 to $100 million trucking company.
Right.
Well, if they didn't get that stepped up cost basis, my guess is it's going to be awful tough to come up with, what are you going to do? Sell 40% of the trucks? It's really difficult. Or I want you to think about all the farmers that we have here in central Indiana. It's long been known that estate taxes are one of the main reasons that families lose their farms.
Yep.
Well, now they're adding this really right on top of it. And it just seems like it's something that we really need to keep our eyes on as we're advising these high net worth families on their largest assets.
Yep. You're exactly right. And that just fitting right in with kind of where we're at now and what we're talking about with the step up in basis. We obviously should go ahead and mention too, the other big discussion around estate planning is, the current lifetime exemption is 11.7 million, I think. I forget if that's 2021's or if that's what 2022 is going to be, but 11.7 million is your lifetime exemption. So in your lifetime, you can gift up to 11.7 million without having gift tax implications on you or the person that you gift to. The proposals early on this year were saying that was going to go back down to 5 million, I think increased for inflation, but back to 5 million, which is what it was a handful of years ago. I forget how long we've been at the increased amount of 11 million. So that, again, was huge. That's where I had a lot of clients looking at that saying, okay, they maybe had some gifting strategies planned over the next, 10 years of their life based on their age or what they were planning on doing. And they accelerated a lot of that to get it gifted before the end of this year to make sure they could use that 11 million. Now that is pulled back out and we're still at the 11.7 million. So again, one of those where we were kind of just chasing our tails, that felt like this year, and trying to plan and plan wisely, preserve our wealth, save in taxes, care for
our heirs,
children, like all of it, and trying to do the right thing. And
there's some charitable aspects in that as well, isn't there?
Exactly. Yes. And then it comes back around where we're back where we started, which again is great news. Now, I will tell you right now that 11.7 million lifetime exemption, it is scheduled to sunset in 2025. And at that point, we would go back to, I think it would be 6 million beginning in 2026. I was talking with one of my tax partners, and he feels like that will probably still change before the end of 2025. He thinks, again, no crystal ball. We talked about that earlier. We don't know this, but he was saying he would be surprised if we really go back down to the 5 or 6. There may be some slight changes to it, but he feels like something new will come along that will keep it at this higher level.
Okay. All right. Well, that's good news, but it's, you talk about chasing your tail. That's really, I know that sometimes in our profession it feels like that, but that's what it really is. When we're stress testing a client's situation and we're putting it through its it's tests. You know, we don't know what the future holds, but what we can do is properly position different strategies so that no matter what happens, the client is still getting the very best outcome. So audience, what I want you to hear from Lisa is that she doesn't know exactly what's going to happen, but she's working with her clients on a regular basis to say, hey, no matter what happens, you're still going to be taken care of. And it sounds like a lot of the actions that people have been taking throughout 2021, well, maybe they were unnecessary this year, but just as easily this could have gone a different direction. So in talking about it going in a different direction, I mean, all we've talked about is, hey, these things aren't changing. Lisa, what is changing?
So that is a great question. One of the big things that, again, when we say is changing, it's if this passes, but one of the things in there are some things that we think will definitely pass that are around foreign tax, and that's kind of its own unique little world. So that's one of those where, without going into a ton of detail, if you're involved in some sort of, ownership in a foreign entity or have foreign tax, that's something we should talk about offline and look at, because there are some changes in there that will likely go through. Yeah. One of the big things that probably affects most people listening, I think, would, at least a majority of my clients do this, I'm sure a lot of yours do, your clients that we don't share, is this backdoor Roth conversion.
Yeah. That's
a very hot topic. Lots of people doing the backdoor Roths. Give a high-level overview of that. It's basically a way to, you can contribute to a traditional IRA, even if your income's too high. So it's a non-deductible contribution to an IRA. And then you can immediately convert that contribution that you just did in your traditional IRA into a Roth. So no current tax implication on that, because you had basis in the contribution you made, you converted it to Roth. So now it's in the Roth that is is going to grow. And then when you take it out in retirement, or when it goes to your children or grandchildren, that's not taxable. So obviously, benefit of having money in that Roth. The BBBA right now has taken away that ability, because basically what they're doing is saying, I mean, you can still convert money from traditional to Roth, but it's going to be on a taxable basis, because basically what they're taking away is that you can no longer make those non-deductible traditional IRA contributions.
Okay, so just to clarify there, we still can do Roth conversions.
Yes.
But what you can't do is what's called the backdoor Roth, which is where you make an after-tax IRA contribution and then immediately convert that to a Roth.
Right.
That's going away from what I hear, not because of the conversion aspect, but because you can no longer make an after-tax IRA contribution.
Exactly.
Is that correct?
Yep, that's exactly right.
Okay.
And this applies to the backdoor Roth that a lot of people have probably heard of, which is, your traditional IRA contribution is $6,000, it may be $6,500 this year.
Yeah, it goes up a little bit each year.
Yeah. And then there is also what's become a little more popular recently is what people refer to as a mega backdoor Roth. It's really the same concept. It's just through a plan where you're able to do, it's through kind of an employer-based plan, and you're able to do after-tax contributions and can get almost $55,000, or it might even be $58,000, a lot higher number that you're contributing to an after-tax and then immediately converting. Same concept, just mega, like it's called.
Okay.
Bigger money. So
is that as popular? I mean, a lot of our clients now within their 401k plans have the option and the availability to make Roth 401k contributions.
Right.
Are we still okay there? And how does that differ from this mega Roth conversion that you're talking about?
So the mega Roth it's different in that there's not the component of contributing directly to a Roth. You're contributing to a regular 401k plan, but using after-tax dollars. So you've done your deferral, your 19.5, and then your plan is set up such that there's additional ability to contribute more. I don't know all the details on all the plans, so it may be where you've got to look at census and look at your highly compensated employees, and those are the ones who are able to do this. But they've got this extra money that they can put away after tax through their employed plan, and then immediately convert that to Roth.
Well, I know you and I have worked on some of those plans in the past, and certainly we're still still able to help people out with that. So we know that the backdoor Roth is going away. The ability to do traditional Roth conversions, that hasn't been taken away from us, correct?
Correct. You can still do that. They will just be on a taxable basis. Now, so, one kind of highlight or planning point to think of is, because you can do these Roth, your traditional IRA contribution and then Roth conversion, you have until you file your return. So you have until April 15th of 2022 to do your 2021 contribution and conversion.
Yeah.
One suggestion that we're encouraging clients, just because when and if they do pass the Senate, when they pass the BBBA, we don't know if it's going to be retroactive to some point in 2021, if it's going to be starting in 2022. It may start in 2022, but if you haven't already done those Roth conversions, you can't still do them.
Yeah.
So our suggestion would be, if you typically do that, and sometimes maybe you don't do it till March or April when you're filing your return, go ahead and get that done before the end of the year.
Okay. So one takeaway there is, if you're going to do an after-tax IRA contribution and then consider converting it to Roth, get that done before the end of this year. What else is changing? Where are they coming up with all this money?
Right. So we talked about there's a couple other between the foreign stuff, and then there's a small corporate tax buyback. So if you're buying back corporate stock, again, that's a very minimal portion of people that will apply to. Another two of the bigger sections where they're getting some of this money that would have probably or could likely affect some of our listeners are going to be this. There's going to be this extra surtax of, now this is for the high income taxpayers. So if we've got individuals with income over $10 million, they're going to have a surtax of 5% on that income. So you're already paying your 37% ordinary tax rate. You have an additional 5% surtax. And then anybody over 25 million will have an additional 3%. So potentially a total of 8% surtax on top of your regular rate. Now, again, these are high income numbers that we're talking about. So it's the very
I don't even know anybody that has an income that high. Is this kind of clientele that you're working with?
I should not have any clients. Now, I say that. I shouldn't have any clients that will be affected by this, unless there could be some in a year of a transaction. If they sold their business, they could have income over 10 million from the sale of their business. So it could apply to some.
And that's where I wanted to go with that, because most people think about, a $10 million income. I mean, come on. What percentage of people actually have a W-2 that reads $10 million, right? I don't know of anybody. But where it does come into play is what, like we mentioned earlier in this conversation, is that we have a tremendous amount of clients that are considering their succession planning, considering what are they going to do with this business that they've worked so hard and they've built up. This is a tax which would absolutely or could absolutely affect those individuals, because in that year that they do that transaction, that year that they sell their business, well, they absolutely could have income over 10 million, as the price of their business could be 20, 30, or like some people we know, they're selling their business for 100 million.
Yeah, exactly. So that's one area. Another thing that is in there that's going to create some of this this tax revenue is there's a 3.8% net investment income tax that's going to be expanded to all business income. So when I say that, you maybe have heard of that. It's sometimes referred to NIT tax. So right now, there is a 3.8% tax on, it's called the 3.8% NIT tax. So it's on your net investment income. So any passive income that you have, your interest, your dividends, your capital gains, and then if you have passive income from, maybe you're an owner in a business, but you don't actively participate in it, that's considered passive income. All of that income currently has this additional 3.8% tax that's applied to it. They are expanding that now so that 3.8% tax is on all business income. So our business owners that are, S Corp business owners that are active in their business, right now they may get a K-1, they get a W-2, that income's taxed as normal, ordinary rate. It doesn't apply to this NIT. Then their S Corp K-1, their income that comes through to them from that, since they're active in that business, it does not, the NIT currently, the 3.8% does not apply to that S Corp income. Going forward, if this passes, it will. So there'll be this additional 3.8% on all business income. So from an S Corp standpoint, that one of the benefits of an S Corp is that you've got this kind of little bit of a play in saving in some payroll taxes, because your S Corp income that you get is not self-employment income. This proposal kind of takes that away. So that small payroll tax benefit you get from being an S Corp will pretty much go away. Not to say there's not good reasons to still be an S Corp, and it doesn't mean you shouldn't be one, but that benefit that people sometimes realize from that is not going to be there anymore.
Well, we're an S Corp, so what I just heard is my taxes are going up.
Yes.
All right. Well, let's kind of wrap up this conversation. I think it's gone great so far, but let's just wrap up this conversation with an overarching, what can wealthy business owners, what can they do in this environment of change and uncertainty? What can they do to make sure that, one, that they're not missing out on any opportunities, and two, that they're not setting themselves up for some type of failure moving forward? What can they do to really improve their situation?
Yeah, I think first and foremost, which we've kind of already talked about in the beginning, is having that right team around them to kind of stay ahead of the game when it comes to preparing or planning or knowing what you've got, knowing the value of your business, and knowing what your ultimate goal is with it and what you want to do with it. Having those heirs that are ready to take over, or are there none, and are there potential buyers out there that you want to consider? I don't think it's ever too early to kind of explore those options and have a game plan of where you think things might go. And I guess I say that with, if anything, this year has proven that we don't know what's going to happen. And we heard all these different tax law changes that were going to have, that could have happened and could have a huge impact on that. So people are kind of rushing around and scrambling to figure out what they want to do to best save. And then now, luckily, a lot of that's pulled back out. But like you said earlier, in 2 years or 3 years or next administration, this could all happen again. So kind of staying ahead of the game and having a plan in mind of what you've got, what you want to do with it, where it's going to go. I think that's always important. Working with your advisors. And now, like I said, there's not a ton of true like tax rate changes or big things going on where you can do a lot to try to avoid. There was 1 year when if corporate tax rates were going to be increasing, we would have said, leave some money in your corporation this year while it's still a 21% rate, and then pay it out next year. Those rates aren't changing, so that's not something that you've got to worry about trying to do. there's always the basics when it comes to year-end tax planning. There's always the basics of looking at your business, or do you have some big capital expenditures? I mean, we always try to accelerate expenses, accelerate any deductions you can. Do you have any big capital expenditures that you might make? Well, if you do that before end of year, you can take bonus depreciation and get that deduction all, in this current year. So kind of some of those typical things that we would look at
Yeah.
and suggest each year. One thing I would throw out there that we haven't really talked about, and it could be a whole nother 30-minute conversation, but I at least want to mention some of the COVID related benefits that we've seen. One of the big ones right now are the ERC credits, or employee retention credits. A lot of business owners may have heard about those and thought, well, my business, I mean, I'm still here, I'm still open, business is going well, I'm sure I don't qualify for those. If you haven't looked into that, you should check on it, call your advisor, ask them about it, because we've got a lot of clients that were able to qualify for some of those credits. And I've got some clients that they're not huge, and they're seeing $130,000 credit, payroll tax credit from these ERC credits. So that's one thing, that there's different requirements that have to be met, and levels of complication and calculation. So we won't go into all that detail, but I do want to throw that out there, that if you haven't looked at it, you should at least explore that and make sure it's a quarter by quarter thing. So there may be a quarter in 2020, because we can go back and amend the payroll tax returns to claim these credits.
Yeah.
So there may be a quarter in 2020 where your receipts were down compared to that same quarter in 2019. They may have been down enough to qualify you for these credits. And it's,
Right.
It's up to, in 2020, it was a potential of a $5,000 credit per employee per quarter, obviously based on certain, calculations and restrictions. But
sounds like there's some opportunity there.
yeah.
And Lisa, I really appreciate your time today. Ryan, before I toss it back to you, I want to reframe kind of what Lisa just talked about. With all the changes that are happening right now, we have changes politically, economically, socially, and as we talked about today, taxation, right? So we have lots of things going on. And I don't know if, in my 20 plus years of experience, if I've ever seen an environment that really lended itself more to getting a second opinion or a stress test upon your situation. Lisa and I both talked about having a team. Well, you more likely than not, you think you already have a team, and they may be doing the right thing, or they may not be. Lisa and I have partnered together before to do what we call a stress test. And that's where, for the busy, successful entrepreneur that's listening here today, what we really want to talk to you about is, where are you at today? And where is it that you're trying to go? What is it you want to do? At that point, we can take a look at all the different strategies that you're using. Your taxation, your estate planning, your charitable, your insurance protection. We'll take a look at all the different things that you're doing. And really, one of three things is going to come out of it. One, hey, everything's perfect. It's exactly the way that it should be. You're taking advantage of every single opportunity and navigating around every single barrier that's in your way. Congratulations. Stay on that path. The second thing that could absolutely come out of it is that there's a couple of items on your opportunity or your checklist board that maybe they're substandard. They are not at the quality that they should be, or maybe the strategies are a little bit outdated. That's an opportunity for Lisa and myself and the rest of our team to raise our hand and say, hey, here's a couple things that you really ought to look at. And, I think you got good advisors. Why don't you go back and talk with them about fixing these minor issues in the plan? The third thing that could happen is that there could be room for significant improvement. that you are currently not maximizing your opportunity and aiming yourself up to the very best future that you have. And if that's the case, Lisa and I are going to partner with you, show you what those opportunities are, and then show you a path as to how we can all work together to fix and improve your situation to make sure that ultimately you end up at your ideal future. And so with that, I just want to throw that out there and say, in my world, if you have any questions at all, if you have any doubts that you're missing out on some things and don't really know where to go, partnering or coming in here, partnering with Lisa and myself to do what we call a complimentary stress test and really taking a look at your situation is the best path to make sure that you're taking advantage of everything that you should. With that, Ryan, I'm going to throw it over to you to wrap this up.
Alrighty, thank you so much, Darrick and Lisa. A great conversation today. Appreciate you both carving time out of your busy schedules to be with us and the viewers today. And then a quick message to you, our viewers. If you like today's conversation, if some of these year-end tax strategies, really resonate with you and your portfolio, please do us a favor. Like the show, comment, subscribe to it on whichever platform you're checking us out on today. And then, of course, share this information with friends, families, those business owners that Darrick and Lisa had chatted about today, because at the end of the day, this show, these conversations, they're meant for you. We're going to be bringing on some great guests, some great partners that Darrick's been working with over these last 20 years, and having some other great conversations with them surrounding some of these wealth management related strategies. And we would hate to have you miss out on any great conversations down the road. So for Mr. Darrick Hutchins and Miss Lisa Curry, I'm Ryan Ruff. We're saying so long today, and we thank you so much for joining us on today's edition of Modern Wealth Management.